This past weekend was Veterans Day, so to get things started, if you're listening and you served in the military or are actively serving in the military, no matter what branch, I want to thank you for providing us with the freedom that we cherish in this country. Thank you. And if you are associated with the military, today's episode is for you. And even if you're not, you probably know someone who has served the country, and the information here within can be very helpful to share with them. So if you don't listen through to the main topic, please consider sharing this episode with those you know who are associated with the military. I sincerely appreciate it. Now, for everybody, I have a story to tell you. I lived in Utah and I lived in a condo. I mentioned it last week when I was discussing grocery stores and reacting to the food theory episode. But I owned this condo. I had a mortgage on it. I was not renting. I owned it. And when I got the mortgage for it initially, I was following the Dave Ramsey rules. So I didn't have a credit card. I didn't have a credit history. I made it through college without student loans. It was hard, but I did it. The consequence of that is I needed to pursue manual underwriting, and I was in the position where manual underwriting does not work. I didn't have any work history. I was a college kid. I had college jobs. I paid through school with those jobs and not much else. It wasn't the kind of job history that shows that I could pay for the mortgage I was trying to get. And none of my past work history was really paralleled to my new career. I had just signed on for the job. So I had proof that I was going to be employed and when I was going to start getting my paycheck, but that was it. I had a letter from the company, nothing else. The signed acceptance letter was not enough for me to pursue manual underwriting successfully. I even called Churchill Mortgage, who is sponsoring Dave Ramsey's show, and is the mortgage company that Dave Ramsey drives people to for manual underwriting. And they told me that I needed a credit score to get a mortgage. And I know that some of Dave's advice here would be to rent for a duration of time, build up that history so that you get the manual underwriting, but I was impatient. I knew that the Salt Lake market, the real estate market there and the surrounding areas was hot. And I didn't want to deal with rent going up or down. And I felt pretty confident I was going to stay there for around 5 years. It ended up being 4, but I still came out on top. I was bound and determined to own right out instead of renting because renting was also month to month more expensive than having a mortgage, even if I didn't get a very good rate on the mortgage. And this was the window that opened up my world into credit cards. So I did get credit cards. I established a credit history and was able to get a mortgage, but my credit history wasn't very long. So the rate I got on the mortgage for the time was not very good. It was a little over 5%. Keep in mind, this is before the plague and the severe drop in lending rates that occurred during that time. So with that in mind, I got a mortgage. I think it was for $175,000, $185,000, and I want to say 5.25% on the interest rate. My plan wasn't to keep this particular mortgage forever. I wanted to wait for rates to drop, and I wanted to wait for some of my history for paying on the mortgage to show up on my credit score, have a higher credit score, and refinance. And I probably waited too long to refinance. I probably could have done it a year earlier. It was sort of hard to know, but I did refinance when rates were really close to 2%. So I was able to get a good rate, even though I had trashed and cut up my credit cards at this point. So all of the credit card history that I have is gone. The only thing that is active on my credit report is my mortgage. And my payment history primarily was based on the mortgage. I still had over 750, 770 for my credit score. It was insane. So when I went to go refinance, getting a good rate was not a problem. Now, this is the question I want you to ask yourself if you ever consider a refinance. I know it's less likely with the higher interest rates right now, but if you're wanting to refinance and go to a lower rate, you need to ask yourself, what is my break-even period of time? Because when you refinance, you're going to experience closing costs again, just like when you bought the home. And those closing costs are not cheap. So when you refinance, you're going to see, hopefully, if you get a better rate, a reduction in how much of each mortgage payment is going toward interest and an increase of how much each mortgage payment is going to principal. And on the whole, if your time to pay off the mortgage is about the same as your initial one, so say you had a 30, you have the home for 10 years, and you refinance with the 20, you keep the end date the same. Well, your mortgage payment should be a little lower only because of the lower interest rate. Now, you're not calculating the difference between your previous mortgage payments. You're calculating the difference between the interest payments that you had. So you're comparing the interest rates, payment to payment, month to month, down the line, and you're adding up the savings between the interests until the cumulative savings is equal to the closing costs you'll experience from refinancing. When you hit that point, that's the break-even point. That is when your refinancing has paid for itself. It has saved you that much money, and that savings has been applied to the equity in your home. For me, because I went from 5.25% all the way down to almost 2, I did the break-even analysis, and it was less than 2 months. I would have been foolish not to refinance the home. Break-even period of 2 months is unheard of, at least in the refinancing world. I couldn't believe my luck when I saw that. So naturally, when I saw that, I refinanced in a heartbeat, and I was very happy to have done so. The refinancing was able to help me build equity significantly faster than I otherwise would have, and really helped line the equity in the condo so that I could afford the down payment on my current home here. And I didn't need to have credit cards or any other loan history other than just paying the mortgage on the condo, the original one and the refinanced one, in order to qualify for a healthy mortgage on this home. I got this home right before rates started to get a little crazier, and I'm hoping that rates will drop below my current rate eventually, and I might be able to refinance again. But there is a warning I need to give you. If you refinance for the sake of refinancing and you kick your payoff period down the road over and over, you might be pushing the payoff date of your mortgage past retirement age. And if you don't plan or don't think you're going to be able to put anything extra toward the mortgage in order to move that date up, you risk running into retirement age and still having a mortgage. When we retire, it's going to be significantly advantageous to have our homes paid for. That way we can remove the biggest bill that is consuming our income right now. The mortgage, living expenses, rent, whatever you're doing to put a roof over your head. If it's gone, you don't need near the income you have now when you retire to maintain your standard of living. And that means you can either retire earlier or not have to save up quite as much in order to retire with dignity.